The learner, welcome to a fresh deep dive. Today, we're zeroing in on the 2025 investment landscape.
Right, and specifically through the lens of Blackrock.
Exactly. We've sifted through their latest investment outlook, their Q1 2025 earnings supplement,
The Q4 2024 earnings call transcript as well, yeah.
and some key news coverage, too. So, our mission here really is to pull out the vital intelligence
Mm-hmm.
about market direction, BlackRock's own strategy, and, the opportunities and challenges ahead for 2025.
Yeah, basically trying to make sense of it all for you, the learner.
Okay, let's unpack what we found.
Absolutely. And right off the bat, what's, well, fascinating from BlackRock's view is this firm belief that we're not in a typical business cycle.
Not typical. How so?
Well, they're really emphasizing these huge transformative
Yeah.
forces, mega forces they call
Like
it.
AI?
AI is the big one, yeah.
Yeah.
Leading the charge. They're saying these forces are fundamentally altering historical patterns, economic relationships too.
Wow. Okay, so it's not just a small tweak they're talking about.
No. It's more like a break from the established norms.
That's quite a statement. So, if the old rules are being kind of rewritten, what does that actually mean for basics like inflation, interest rates?
Yeah, good question.
Sounds like they don't see us going back to the pre-pandemic normal anytime soon.
Precisely. Their analysis points to, well, persistent inflationary pressures.
Persistent. Why? What's driving that?
It's a convergence of big trends, really.
Right.
Think about increasing geopolitical fragmentation that messes with supply chains.
Right.
Then there's the massive capital needed for the AI build-out and the low-carbon transition. Huge investments.
Okay, that makes sense.
And even things like slower immigration, potentially impacting labor supply, wages.
Yeah.
It all feeds in.
So all these factors combined keep inflation up.
That's their expectation.
Yeah.
And because of that, they think long-term Treasury yields are likely to trend upwards. Investors will want a higher premium for those risks.
Got it. So the era of super low inflation, near zero rates, probably done, firmly in the rear view.
Seems that way, according to them.
So if that's the new reality, how should investors adapt? A simple 60-40 portfolio might not cut it anymore.
You've hit on a crucial point there. Their emphasis has definitely shifted towards thematic investing.
Thematic, yeah.
So instead of just overweighting, say, equities or bonds generally, they're advocating focusing on the specific, powerful trends driving growth and disruption, like AI, like the energy transition, demographics.
Focus on the themes, not just the asset class.
Exactly. And this also means needing a more tactical approach.
Tactical, so more active adjustment.
Right. Given that these underlying trends could shift quickly, they believe investors need to be more nimble, adjust portfolios based on shorter-term signals.
That agility feels key in a world that's, well, changing so fast. Now, despite this outlook sustained inflation, maybe higher rates BlackRock still seems to favor risk, particularly U.S. stocks.
Yeah, they do.
What's the thinking there? Seems a bit counterintuitive, maybe.
Well, their pro-risk stance, especially overweighting U.S. equities, is largely based on their view of U.S. corporate strength, resilience.
Right.
And they also point out that the AI theme isn't just a few mega-cap tech stocks anymore. It's broadening out.
Ah, so it's spreading across the economy.
Exactly. Becoming more integrated across different sectors in the U.S. They think that positions the U.S. really well to capitalize on these mega forces.
Makes sense. But they must have some watch-outs, things that could derail that view.
Oh, absolutely. They're keeping a close eye on a couple of key things. One is a sudden sharp jump in long-term bond yields that could hurt equity valuations.
Right.
And the other is a major escalation in global trade protectionism. That could obviously disrupt earnings.
Okay, so even their convictions have caveats. Good reminder. What about opportunities, say, beyond the U.S.? Are they only focused stateside?
No, definitely not. They do see interesting spots elsewhere. Well, first, even within the U.S., they acknowledge valuations in the, top 10 biggest companies are high, like 35 times earnings, roughly.
Steep.
Yeah, but outside that group, the broader market is closer to maybe 20 times earnings. Much more reasonable.
Okay.
And globally, they don't think valuations overall are stretched. They see potential for active managers to find value, generate that alpha.
So opportunities for stock pickers.
Potentially, yeah. They even talk about global bargains in European stocks.
Europe? Really? Given the headwinds there.
I know. Sounds a bit contrarian. But they argue many European companies are truly global, strong in areas like electrification, renewables, and trading at a big discount to the U.S.
Interesting angle. What else globally?
Well, global commodity companies look interesting to them, especially things like copper.
Ah, for the energy transition and data centers.
Precisely. Big demand drivers there. Plus, they're looking at select emerging markets benefiting from supply chain shifts.
Reshoring, nearshoring, that
Yeah.
kind of thing.
And also Japanese equities, driven by corporate reforms and, finally seeing some inflation.
Okay. And is there a common thread? What kind of companies do they like generally?
Across the board, they emphasize companies with strong quality metrics. Think robust free cash flow, low debt, growing
And
dividend.
resilient types.
Exactly. Those are likely to hold up better in this evolving environment.
So a pretty nuanced global picture. U.S. strength, yes, but definitely looking for value and specific themes everywhere.
Oh.
Okay, let's pivot a bit. Let's talk about BlackRock itself, their own performance, their moves. The numbers look pretty impressive.
Absolutely. 2024 was a huge year for inflows. Record $641 billion net inflows.
Wow.
And that momentum carried right into Q1 2025. Assets under management hit $11.6 trillion. Unprecedented.
$11.6 trillion. That's just staggering.
It really is. And importantly, they saw strong organic base fee growth in 2024, and that's continued.
Organic growth meaning new money coming in, not just markets going up.
Exactly. It shows real underlying demand for their services, separate from market moves or acquisitions.
And where's all this money flowing? ETFs seem like a big part of the story.
They are, absolutely. Huge inflows into ETFs, especially active ETFs, interestingly.
Managed ETFs aiming to beat the market.
Right. And their Bitcoin ETP was also a massive success, one of the biggest launches ever, apparently.
Right, I remember reading about that. What else besides ETFs?
Well, there's strong demand for their private market offerings, too.
Yeah.
Areas like infrastructure, private credit, getting a lot of attention.
Mm-hmm.
And it's not just investments. Their tech services, driven by Aladdin, are also growing significantly.
Aladdin, right. That's their big risk and portfolio management platform.
Yeah. It integrates everything, public, private markets.
Mm.
It's a core piece of their offering.
And they're constantly upgrading it, I assume?
They are. And speaking of strategic moves, they've got those big acquisitions planned, Preqin and HPS. Expect to close this year, 2025.
Right, Preqin and HPS. What's the strategy behind those deals? Seems significant.
Very. The Preqin deal is really interesting. BlackRock's stressing how crucial better data and analytics are in private markets.
Why now?
Well, partly for better investment decisions, obviously, but also for navigating regulation, especially around retirement savings.
Ah, so good data could help open up private markets for retirement plans.
That seems to be the bet. They think better data will fuel regulatory opportunities there.
And HPS, what's the goal with that acquisition?
That's more about significantly boosting their private credit capabilities,
Mm-hmm.
especially for insurance clients and private wealth channels, big growth areas.
Okay, so one is data and analytics for a growing space. The other is expanding product in high-demand segments. Makes sense.
Yeah, a two-pronged attack, really.
Yeah.
And they're working hard to integrate these private market solutions into their regular managed models and SMAs.
SMAs, separately managed accounts, right? Custom portfolios.
Exactly. They want to make it easier for wealth managers to actually use these complex private market products. Their partnership with Partners Group is an example of that.
Simplifying access.
Right. And in Europe, they're expanding ETFs, but also launching these evergreen funds. LTIF 2.0, they're called.
Evergreen, meaning more accessible for individuals.
Yeah, designed to give individual investors easier access to private equity, other alternatives. They're planning similar ones for infrastructure and private credit, too, exploring similar structures for the U.S. as well.
Sounds like they're really trying to bridge that gap between public and private markets for more investors. Let's shift now to fixed income. What's the BlackRock outlook there for 2025?
They're expecting a more balanced term structure of interest rates.
Term structure.
Yeah,
The yield curve, basically. The relationship between short and long rates.
exactly. A more balanced or maybe steeper curve. They see that as a key signal for more demand for intermediate and longer duration bonds.
Okay. And do they think investors are ready for that?
Well, they point out that investors are generally underallocated to fixed income right now.
After years of low rates, maybe?
Probably.
Yeah.
And they think a huge amount of cash. They mentioned something like $10 trillion sitting in money market funds.
10 trillion.
Wow. Could eventually move into fixed income as the curve gets more attractive and rates stay higher.
That's a massive potential shift. What kind of fixed income would see the most demand, do they think?
They see strong demand across maturities, public and private debt, especially intermediate and longer duration. And they also highlight spread income as a big opportunity.
Spread income,
Yeah.
the extra yield on riskier bonds compared to governments.
Exactly, earning that extra yield.
Yeah.
And interestingly, they also suggest that because equities did so well in 2024,
Yeah.
some investors might be overweight equities now and might look to rebalance back into fixed income.
Portfolio rebalancing driving flows.
Could be part of it.
Yeah.
And their own fixed income business saw strong inflows last year, $164 billion. So the trend might already be underway.
Okay, so fixed income may be poised for a comeback after being less popular for a while. Now, we touched on retirement earlier with private markets. What's the bigger picture for BlackRock on retirement solutions?
Yeah, innovation in target date funds is a huge focus. Their life path paycheck product.
The one with guaranteed income built in.
That's the one, using annuities within the target date fund. They say adoption is rapid.
Interesting.
And they're actively working on how to maybe include private markets in target date funds too.
That seems complex regulation-wise.
It is. That's where they think the better analytics from the pre-Quinn deal will be crucial to navigate the rules and fiduciary duties.
Makes sense. It's about managing that risk and complexity.
Right. And simplifying access for wealth managers serving retirement clients is key. Those managed models we talked about. And the ELTA funds in Europe also fit into that picture for retirement savers.
So building more sophisticated, maybe more secure retirement income solutions beyond just stocks and bonds.
That seems to be the goal, yeah.
Okay, finally, let's quickly cover BlackRock's own capital management. How do they handle their own money? Sounds like a pretty set approach.
Yeah, it's quite consistent. Priority one is always investing back in the business, organically, and through deals like Preqin and HPS.
Growth first.
All right. Then after that, the focus is returning excess cash to shareholders, dividends and share buybacks.
And they have a track record of buybacks.
Yep, long track record of systematic share repurchases. They've targeted $1.5 billion in buybacks for 2025, market conditions permitting.
Okay.
And they also said they expect to increase their dividend in the first quarter of 2025, continuing that pattern.
So disciplined, shareholder-friendly. Growth first, then return cash.
Pretty much sums it up.
Okay, the learner, let's try and synthesize all of this. What are the really key insights to take away from this whole deep dive?
Okay, key takeaways for you, the learner.
Mm-hmm.
First, we're in a market that's really changing. Old economic patterns. They're being disrupted by these big mega forces, especially AI.
So things are different.
Very different. And that means needing a more thematic approach to investing. Focus on those trends. And be agile, be tactical.
Don't just set and forget.
Exactly. Now, BlackRock is still constructive on risk, like U.S. equities, corporate strength, AI broadening out. But they also see real opportunities globally. Undervalued European stocks, maybe, certain emerging markets, and definitely fixed income looks more attractive now.
Okay, opportunities are specific, not just general market calls.
Right. And strategically, BlackRock itself is positioning for this future. Big moves in private markets, technology, aiming to integrate public and private assets better for clients, including for retirement.
Got it. A transformative environment needing a thematic, tactical approach with specific opportunities globally, and BlackRock positioning itself accordingly.
You got it.
And on that note, here's maybe a provocative thought for you to chew on. If these traditional economic trends really are breaking down, if these mega forces are reshaping everything, how might that force you to fundamentally rethink your own investment strategy, your own analysis?
Good question.
Are you focused enough on identifying these big themes? Are you set up to be nimble tactically? And maybe most importantly, how are you staying informed about all these rapid changes?
That's definitely something worth some serious thought. How do you adapt your own process?
Exactly.
And we definitely encourage you, the learner, to maybe dig into BlackRock's full reports yourself. Explore the landscape with these ideas in mind.
Yeah, understanding these perspectives, especially from a giant like BlackRock, is pretty crucial for navigating the markets in 2025 and well beyond.
Absolutely.
And that brings us to the end of this deep dive. We really hope this gave you some valuable perspective. Join us next time as we dig into another vital topic. Until then,
Keep learning. Keep that curiosity going.